Well, let's now introduce on the show somebody from the industry, from the mutual fund industry, to sort of understand what the impact of all of these norms is going to be. We have with us Lakshmi Iyer, CIO of Fixed Income and Head of Products with Kotak Mutual Fund. Lakshmi, thank you so much for taking out time, to explain this entire norm and regulation for our viewers. So to start with, let's understand that. And let's also understand that why mutual funds invested in perpetual bonds, AT1, what did it add on to the mutual fund in terms of returns, in terms of risks, and what impact obviously is this notification going to have?
Firstly, AT1 or additional tier 1 bond or perpetual bond as they are called are essentially bonds which are subordinated to the senior bonds, or because they are capital requirements which are largely banks are the issuers. Of course, there are other issuers as well. Now, in the market, perpetual bonds do not have a defined maturity date. Because these are hybrid instruments. You don't call them debt instruments, you don't call them equity, they are hybrid instruments. So it has a coupon rate, but it doesn't have a maturity date. But however, it has a call date. Now, we have typically seen historically, whether it's in India or world over, that these bonds trade to call, or we call them buy TC or yield to call. And the reason for that is there is a period, which is usually 5 years, after which these instruments get called by the respective issuer. This is the typical norm that we have seen. Now, what is the new regulation change? And therefore, the valuation was happening as per yield to call. Now, under the proposed circular, what it says is that now there will be maturity, and the maturity date for such perpetual bonds will be taken as 100 years. So that is the new change, which will mean, so the two implications. One is, from a credit profile perspective, the mutual fund risk does not go up because it's the same credit. So if you're comfortable with a high-grade PSU bank, you're comfortable with buying the tier 1 bond. However, the duration of the portfolio could inch up a bit. And most importantly, it is the valuation of the bond that could undergo a change if it is implemented in this avatar.
Okay, understood. So, clearly there are two options. One is that, the mutual fund would have to adhere to what the valuation norms are as per SEBI for these kind of bonds. The second is that they perhaps trim their exposure in these perpetual bonds if they believe that it could, hurt the returns of the debt fund in question. So let's understand the first scenario where they decide, where, you have to adhere to what the valuation norms are. Like you mentioned, these perpetuity bonds, they go on for perpetuity. But now SEBI is saying that, look, you value these bonds, the present value of these bonds, which will be, of course, reflected in the debt fund as well, which owns these bonds, will be calculated based on keeping a maturity of 100 years. So now, of course, like you said, the call option, etc., can come in 2 years, 3 years, 4 years. So how does this calculation impact the NAVs? Is there a certain percentage, if you may have calculated that for your funds?
So, before I get into the impact of the NAV, Mubina, there is a third option also, that the industry actually engages with the regulator and tries to find out a way to smoothen this entire process. And that's exactly what the industry is seeking to do at this juncture. To answer your second point, if there were to be an as-is, whereas kind of a situation, yes, it can have an impact on the NAV, but one needs to be mindful that this is a mark-to-market impact, which means that unless you trigger a panic button and go to redeem from a mutual fund scheme, that loss for you is a mark-to-market or a notional loss. It is not a real loss. The second thing is, of course, we've seen today's market movement so far. In fact, the bond markets have already, almost closing. We have not seen any, I would say, panic situation to actually rush to the exit window. Because let me reiterate, this is not a credit event. This is a process change as far as treatment of valuation for a particular category of investment is concerned. And therefore, we will, as an industry, engage with the regulator and see how this entire process can be smoothened out, with recognizing that the regulator has, in the right spirit, introduced A, exposure norms, and B, obviously valuation norms.
Yeah, of course. I mean, I'm sure the communication with SEBI, with the regulatory agency, will be on. What happens then, Lakshmi, if mutual funds decide that, okay, we don't want to sort of have too much exposure, this valuation change is not really helping us and we want to trim this. Maybe they will not eliminate it entirely, because I understand that obviously, and AMFI as well has said this, that mutual funds any which ways hold perpetual bonds and AT1 bonds within the new cap that SEBI has put forward. But still they may want to, lighten their burden a little. So will their NAV be impacted? And also, do you think that it could sort of lead to, a spike in yields? Do you think the quantum could be that much that could lead to a spike in yields? How would it impact other debt funds, particularly maybe long duration funds?
Mubina, the most important part, if you actually go through the circular, is that while there has been an exposure cap which has been introduced, which is at 10% right now, the regulator says that all existing exposures will be grandfathered. And grandfathering means that even if you're holding 10.1% or 11 or 15 or whatever that number is, you do not need to stress sell just because you have to adhere to this circular. So I think that is an extremely important point that viewers have to note, that mutual funds will not really come under duress to exit these bonds because of this regulation. So I think that's something which is important. Yes, if you say in an eventuality that somebody wants to exit, will there be an impact? It's too early to say, because there have been no trades. People are still trying to understand and absorb the impact of what this means. Also, let me tell you that for the non-mutual fund holders of such bonds, it is life as usual. And if they believe that there is merit in the ownership of these bonds, we could actually see them emerging as potential buyers in the market. The market will evolve over time, and we will get more clarity on this front. Till such time, I think right now there is absolutely no levels which have been established in the market.
All right. So just, so that our viewers as well can make sense of all of this and really understand if it impacts them, because obviously these kind of bonds and instruments are not held in every mutual fund. So within the debt fund umbrella, what are the categories that commonly hold these kind of bonds, and where you would find these kind of bonds the most?
So the ownership of this category of bonds has been across fixed income. Given that there have been very short, duration caps at liquid front end, that category invariably is excluded because these bonds do not have, a maturity date. But by and large, if you see from an industry standpoint, these instruments were the underlying of which were largely found into credit risk oriented funds, into hybrid funds like debt equity or the hybrid balanced advantage. Those are the kind of categories predominantly. We've also seen such kind of exposures in banking and PSU funds because the underlying, as I said, are predominantly bank and high grade bank issuers. So that's some sort of a breadth of ownership as far as these bonds are concerned.
All right. So finally, Lakshmi, if you have to wrap it up, let's say if a debt fund holder finds that, okay, this particular fund has a lot of perpetual bonds, etc. What do you recommend he do? Adopt patience and a wait and watch approach?
Absolutely. There is no doubt in my mind. Panic only aggravates pain, and we are nowhere remotely in a credit kind of a situation. And I think I would like to seek to bust this myth, for the audience and the viewers, that panicking is not going to assuage the situation. It will only aggravate it. So stick to your asset allocation, stick to your intended time horizon. We, as I said, as industry will certainly engage with the regulators. Regulators are very open to discuss these things, and just to ensure that there is smooth passage of such process and not a disruptive process.
All right. Well, Lakshmi, it was a pleasure having you with us. Thank you so much, just for breaking this entire bit down and explaining it to our viewers. I hope, they've got a better sense of where things stand now. Ladies and gentlemen, of course, you can always connect with us. Our email address is themoneyshow@etnow.tv. Email us any questions, queries, clarifications that you may have on this topic, and we'll be sure to take it forward with our personal finance guests. We'll inform you as well as to when your query is being taken up. So stay tuned to The Money Show. But for now, we'll take a very short break and be right back.